The payoff structures that exist tend to either be short volatility or long volatility. And so because there are really only two ways you can invest, you can be short vol or you can be long vol, it would be absurd to say, I only do one of the two ways, right? It's like, I only make left turns at traffic signs. If you're not desperate, if you actually have the capability to say, you know what, I want to earn a reasonable rate of return, you can flip to the other side of that.
For years, regulations have vastly limited the investable universe for both retail and professional money managers alike. But recent changes to these regulations have opened up ETFs to strategies previously only available to the most sophisticated investors. This means that for the first time ever, people like Mike Green and Paul Kim can embed option strategies into ETFs for investors at any level. Paul and Mike discuss these opportunities in the current environment and the exciting new strategies they will employ so that you can take advantage.
So I want to first welcome you to Simplify. It's a very recent joining, first interview together. I'm looking forward to it.
Yeah, no, I'm thrilled to be here. It's an incredible opportunity, and to move back into a space where the products that I'm invested in as a portfolio manager are available to the public is something I haven't had since I left Royce back in 2004. And the rule change associated with the derivative rule that hit last year that enabled ETFs to introduce derivative structures, as distinct from the futures-related structures that we've seen with the levered ETFs in the past, just created the opportunity that, obviously Harley Bassman, highlighted it to me and pointed out what he was doing. And so the opportunity to come on board and begin to actually introduce these strategies into the public vehicles was an opportunity I just couldn't pass up.
So we're going to talk a little bit about volatility. Why do so many people associate the VIX or VIX futures with volatility? Why is that the first number that people think about?
Well, because it was the first number that came out, right? So the VIX, similar to Harley's MOVE index and the rates, although the VIX is obviously much more well known, the VIX is a measure of the implied volatility across the strip of all 1 month S&P options, right? So everything that you can go as far out of the money on the downside in a put to as far as you can go out of the money on the calls, anything that is tradable or quotable is incorporated in that. And so one of the reasons that it's so popular is it's an accessible number that tends to move in the opposite direction of the equity markets. So when equity markets go up, vol tends to retreat. When equity markets go down, VIX tends to spike. That has led to its designation as kind of the fear index, and people use it as a reference point to get a sense of what sentiment is in the space.
And it's become more recently through things like the ETFs or ETPs that cover particular VIX futures, an investable asset, if you will. Although I think we have friends who claim volatility itself is really the only asset class. But what are your thoughts on how investors are currently using the investable part of VIX, i.e. the VIX futures?
Well, so to hit on the first part that you highlighted, this idea that it's the only asset class, I would say that it's a feature of any asset class, right? And the payoff structures that exist tend to either be short volatility or long volatility. And so, Chris Cole, a good friend of mine and friend of ours actually, who really introduced that kind of terminology, the idea that volatility is the only asset class. What he's referring to is it's a consistent feature and you're either long it or you're short it, right? So you're very short it in products like investment grade bonds. You're long volatility if you buy puts on the S&P, for example. You're typically long volatility if you buy puts on the S&P. Couple of points that you hit on there, the idea of whether it's tradable or not, and the introduction of UX futures in 2005. So the introduction of the VIX itself goes all the way back to 1986, and so it predates the 1987 crash. At that time, it was actually constructed recognizing the difficulty in doing the mathematical calculations. It was only calculated on the 50 largest stocks in the S&P 500, so it wasn't actually even calculated on the S&P 500. The character of how it was calculated was slightly different because there was less of a range, et cetera. And over time, it became such a reference point that there became a desire to actually begin to trade it. And so with the introduction of UX futures in 2005, it became somewhat tradable, right? But that exact 30-day point that the VIX represents, and again, that's changed over time in terms of how that's calculated a little bit, but that exact 30-day point really isn't a replicable feature, right? So you can't maintain that constant exposure, et cetera. The introduction of ETFs, and again, it goes back to why I joined Simplify, made those products that were only available in futures available to the retail public. And how those products were designed and why those products were designed, products like XIV or VXX, the challenge associated with putting that out into the retail space was one of education.
Yep.
And in the aftermath of the global financial crisis, there's just an incredible amount of desire for ways to protect portfolios. We still see an element of that, but it's decreased significantly. Obviously, the COVID crash in March 2020 raised awareness again, but the very quick recovery that we've seen, I think, has by and large led a lot of people to say markets can't go down, right?
Yep. So the inverse correlation with equities, particularly the S&P 500, is why people value it so much as a hedge. But how reliable is it? How convex is it? How useful is it as a hedge for portfolios in your view?
Well, it really depends on the environment, right? And so the difference between an S&P put and a VIX call, for example, right, where, again, it's negatively correlated under most circumstances, that VIX call should go up, rise in value at the same time that an S&P put is rising in value. And there's two components to that, the implied volatility and the directional dynamics. It can be incredibly useful if you're coming from an environment in which volatility is relatively low. And then the second thing that I would argue is that what's referred to as the term structure, the shape of the volatility curve surface. So the first month future, the second month future, the third month future, their relationship to each other ultimately determines the carry characteristics.
So let's talk about that, because I think in my view, there's sort of two main applications, right? There's the hedging aspect because of the inverse relationship with S&P historically, but there's also a really attractive carry aspect because that curve is usually sort of positively sloped. And so let's talk about each of those. We touched a little bit on the hedging, but maybe you could talk about how someone could take this sort of volatility premia from this curve and use it to generate really attractive carry.
So the dynamic of volatility, again, is designed in the system of the market to represent uncertainty, right? And so one of the features of uncertainty is that it becomes less so as you move forward in time, right? What are you going to have for dinner? You may not know exactly right now, but by the time you've eaten dinner, you will know with absolute certainty what you had for dinner, right? Volatility surface behaves in a somewhat similar fashion. In general, you're more uncertain about what's going to happen further off into the future, and so the normal shape of that vol surface is to be steep, right? So right now, for example, the VIX is somewhere around 18, 17, and the one-year forward vol is probably somewhere in the 25 range. You can short the second month UX futures and ride that down to the first month UX futures, where you are selling high and buying back low in a positive carry type dynamic. And when you look at products like XIV, for example, which had done extraordinarily well in the time period from its launch in 2011 until its demise in 2018, the lion's share of those gains were not caused by the directional move up or down in the VIX itself, but were actually created by the carry characteristics of that forward sloping futures surface.
Yep.
The value associated with that is that it can be used to create a yield type structure, right? So if you do that on a systematic basis where you're selling the second month and buying it back as it rolls down to the first month, that should generate a return that is both predictable and high frequency in nature.
But there's no free lunch, so what's the catch to that steep curve?
There is no free lunch because the catch to that steep curve is when a significant risk-off event occurs, and that uncertainty gets pulled into the future. COVID would be a great example, right? Some significant uncertainty in terms of what the world is going to look like in a year, but the magnification of that uncertainty at the very front of the surface, what's going to happen in the next week? Is the Fed going to step in and facilitate a path? Is the Treasury going to step in with support? Is Congress going to step in with stimulus? Who is going to blow up? Who's going to be forced to sell, et cetera? All of that uncertainty gets pulled to the front of the surface. And in that scenario, you had the VIX spike to 86. And if I looked out a year at that point, the 12-month future was somewhere in the low 30s, right? Maybe even high 20s now that I'm thinking about it.
Yep.
So that turns that system around and you experience that incredible whip because, again, you're short at the front. It rips upwards and can prove quite catastrophic.
Which explains why there's so much uncertainty and risk priced into the carry.
Absolutely.
But also it presents an opportunity for people who are able to mitigate some of that risk and find a better structure to perhaps clip that coupon?
Well, interesting features emerge in the aftermath of events, right? So going into the Volmageddon events of February 2018, you actually had tremendous retail participation in products like the XIV and SVXY that offered 100% inverse exposure to the VIX, right, or to the VIX surface. And the carry associated with that, because the volatility had become so compressed at the front end, you were regularly seeing VIX prints sub 10. That steepness of the surface at that time, going out a year, it was somewhere in the 18 range. And even if I went out 2 to 3 months, you would have seen a vol surface that priced something like 16, right? So that move from 16 to give or take 10, right, is a dramatic increase in return that can be captured in a very short period of time. The offset to that is that the required change to cause a product that is that levered to go to zero is very small, right? So if the front end of the UX surface is at 10, all it has to do is go to 20.
Which
right?
is
So
the historical average for VIX.
pretty darn close, right?
Yeah.
And so the ability for that to flip in that manner is really what had emerged in that framework.
So then let's flip the side of the equation on the opportunity to use as hedges. And certainly you could go long the future, which means you're taking essentially almost a linear bet that VIX, at least some of those months, are going to go up. You could also buy calls on the VIX futures or buy calls on these ETFs. How does that work, and is that ever an attractive trade, and how would you sort of think about it?
The outright calls are rarely an attractive trade on themselves, again, because of that steepness. So one of the features of options is that they are struck against those forwards, right, that future space. So if I'm buying a 3-month call option on the VIX, trying to protect myself for this quarter, instead of getting it at today's price of 16, I'm getting it at the 3-month price of 21, right? So that's where my break even moves to. And then the second component is because the VIX itself is much more volatile in percentage terms than something like the S&P, you tend to pay a pretty high premium for those call options. Where it does get interesting, though, is when the system moves into the type of contango that we have today. Contango meaning the forward pricing is higher than the current pricing. Then you can actually start to construct products that behave similar to how XIV was behaving, where they offer positive carry. But you can cap that exposure, preventing that kind of go to zero type framework by buying a significantly out of the money call option against the shorter dated move. You fully expect to lose on that call option, but you're actually able to position yourself for it. And this is one of the things we've obviously started to work on the new product SVol, right? And so SVol is kind of the second coming of XIV. And so it's ironic, given the role that I played with XIV, that I'm involved in a short vol. I can hear the collective gasp
you're
coming
not
from
known
the real,
for your short vol views.
I can hear the collective gasp from the Real Vision audience, right? But it's actually really important to understand that because there are really only two ways you can invest, you can be short vol or you can be long vol. It would be absurd to say, I only do one of the two ways, right? It's like, I only make left turns at traffic signs, right? Regardless of the opportunity to make a right occasionally or go straight. In this situation, you've now recreated some of the steepness of that curve. Simultaneously, people are much more concerned in the aftermath of coronavirus. And then the last part is that people are struggling for yield. Right? In the same way they felt this in the 2015, 2016, 2017 time period, we're back into an environment in which people are really struggling to identify the sources of yield. Much more so than even then. You've seen compression in the corporate space. You've seen the forwards are dramatically lower in terms of US rates. So the forward expectation of rate increases is lower. And that raises the need for ways to be short volatility to generate yield.
And there's a great story, actually, and we'll get to your key point because it's probably an important one. This reminds me of when I was at PIMCO, in sort of the forums, which is sort of a gathering of the investment professionals. They're talking about, at the time, some of the available yields in the periphery, right? So really interesting bonds, Italy, Portugal, et cetera. And the question wasn't, do we like the bonds? Because people kept saying, oh, we hate the bonds, these are bad credits. The question that Bill posed for the group was, at what price do we like the bonds, right? So a lot of this stuff, including your view on shorting volatility, comes down to, at what price, at what value do you feel the risk reward tilts in your favor, right?
So there's that component, and then there's also the component of just what insurance are you protecting yourself against the unknown, right? So the XIV had two characteristics that concerned me. One was that it was truly uncapped. So if that front surface spiked, there was no limit to how much you could actually end up losing other than being completely wiped out. And the magic of compounding is you can go up and up and up and up, but if you have a down 100% day, you've lost everything no matter what. So ameliorating that by buying an out-of-the-money call option, which perversely is actually more easily accomplished today in the aftermath of those types of events. The range of options that are traded, the frequency with which they're traded, et cetera, has increased. The second component is the appropriate use of leverage. And this is something that people have heard me hammer on over and over and over again. And it's one of these things that even when you hear somebody say it, it's very tough to know what is the appropriate level of leverage, right? I mean, it's not quite, obscenity where, you know it when you see it sort of stuff, but there is an element of how do you want to appropriately do this? And so XIV was 100% inverse to the VIX and exposed it to those relatively small moves. And in exchange, you were getting these incredible returns, right? 20% a month sort of returns, right? Yep. Nobody needs 20% a month, right? I could make a joke about the DeFi space where people seem to really like that sort of stuff.
No one would say no to 20% a month either.
Well, but there's a reason why you should, right?
Exactly.
Because that risk has to be compensated. And if somebody's offering you that sort of return profile, you have to ask yourself, what is the risk of the catastrophic loss where I lose everything? By dialing back that exposure within a product, right? So in the case of SVOL, which we're about to introduce, it's only 25% leverage. So we're doing a 0.25 beta to that change in the VIX surface. You're able to lower the product's volatility. You're able to turn it into a more manageable product. And combining that with the capped feature in industry parlance, it turns it into what's called a capped variance trade. Actually, it's just an interesting another aside. Malachite Capital that blew up in March 2020, they were the characters that were out there buying that tail, right? They were providing the insurance on that cap. In this case, we're actually going out and being able to source that from the exchange. Yeah. So again, it's not a direct counterparty risk that you might have had in the case of selling an uncapped or buying an uncapped variance swap.
So this structure, by the way, and the idea behind this strategy is in one sense very basic, right? Mm-hmm. On the other hand, why is there such an opportunity to generate the type of yields and carry that we think is possible in that structure? Why hasn't that been arbed away yet in a world of 0% rates?
Well, I don't think that it can ever be quote unquote arbed away, right? Because there is no certainty about the future. And arbitrage by definition basically requires you to be certain about the equivalence of something. So if I knew for a fact that the future was going to look exactly like the past, then I could describe it in an arbitrage type situation. Yep. We've got some outlier dynamic. We're never going to know that. So all you can do is you can construct a portfolio that you think will actually protect you against that outcome. In this case, where we're buying those top strike call options to create that capped exposure is such that even, we're combining that with a reduced leverage so that you really don't have that same risk of catastrophic loss, right? It just can't move in quite the same way. Now, anything can happen, right? And certainly the product can be exposed to losses, but that's going to be true in any carry trade, right? By definition, carry is one of the preeminent short volatility expressions. Yep. And again, it goes back to your Bill Gross's observation, at what price do you want to do this? Because you have to take risk.
Yep. Just like the yield curve, right? This term structure once in a while inverts. Mm-hmm. And I think the stats from the CBOE was that it's a positive slope, i.e. contango 80% of the time. But when do you see the 20%? When does this carry sort of reverse?
Well, the carry reverses, again, think about it in the uncertainty space, right? Effectively, it's when the uncertainty gets pulled into the forward space, right? Today, I'm uncertain about something relative to the future. Great example would be an election. We've got two platforms that are relatively clear, Joe Biden, Donald Trump. The uncertainty is around who gets elected. So that creates a kink in the vol surface. We actually saw this
empirically
in November of 2020. We also saw it in November 2016. And that's one of the reasons why we actually see markets rally on those events. It's not like the market suddenly woke up and said, oh, I've decided that Joe Biden's platform is so much more attractive, or that Donald Trump's platform in 2016 was so much more attractive. What the market is actually reacting to is that reduction in uncertainty means that the implied volatility that's here today declines.
Yep.
Right? And that tends to reduce the need to hedge portfolios. You'll see portfolios flip, you'll see markets move around to reflect the new information. The components of the market can move around, but the aggregate reduction of uncertainty tends to be bullish for the markets.
Why is there some sense of mean reversion in the VIX? What pins it back to sort of if you look at graphs of VIX over history, it generally tends to mean revert over periods, but why is that? What forces that?
Well, there's questions about that, obviously. In general, vol is what's referred to as mean reverting. It tends to have a relatively stable distribution, and part of that is simply because maintaining extraordinarily high levels of volatility or uncertainty makes the world uninvestable. And as a result, valuations fall, right? If you just think about that in kind of a framework of saying, well, how am I feeling in that situation, right? So put yourself back on March 23rd, 2020, the VIX is at 86, and I turn to you and I say, hey, what's the business decision that we're making? Are we going to build the factory or not, right? And your reaction is, of course, the world is falling apart. Why are you asking me to make this decision now? Of course, the answer is no. And so if I have an expiring real-world option that says, if I don't build the factory today, then the price of that factory falls, the price of the land falls, et cetera, and it becomes available for the next person. And effectively, the return on capital begins to rise. That very high return on capital, in turn, creates the feedback loop that causes somebody to say, you know what, that's attractive to me. So now I'm going to step in. Once they make that decision, the uncertainty again begins to fall, and the process straightens itself out.
How should an investor think about the various risk premia out there, whether it's equity, it's credit? How do you think about volatility, at least in terms of VIX, relative to those premia? And how much of this premia is liquidity versus credit or sort of a idiosyncratic risk?
So it depends on the individual environment. So you hit on something that's actually really important that was very, very manifest in the COVID crash, which is the dynamic of liquidity. I laugh because I still remember being in college and having one of my professors put his foot on my desk and leaning forward and saying, Mr. Green, define liquidity. And I've never forgotten that, but the characteristic of liquidity is having certainty about the price at which you can buy or sell something. I go to buy a new car. New cars are relatively liquid because they have an MSRP on them, et cetera. I go to sell my used car, buy a used car, there's a significant amount of haggling that exists around that, right? Because there's a lot of variables that are in play and uncertainty, and there's not a financing backstop that's there, et cetera. Equity markets behave in a very similar fashion. So when you get into the environment of March 2020, that uncertainty as to what the next price is going to be enhances volatility, right? I buy something, is it going to immediately mark down against me? Or I go to sell something, is it going to immediately move dramatically higher or lower, et cetera, right? It's very hard for me to know that in that environment. And mechanically, that manifests itself in the option space because market makers want to hedge their positions. So when I buy a call option or when I buy a put option, most of the time, particularly in that type of illiquidity, there's not another speculator on the other side of the trade. There's a market maker on the other side of the trade. That market maker doesn't want to take a directional position. They're not being paid to take a directional position. They don't want to have the exposures. So they need to be able to go out and hedge. And in that reduced liquidity environment, their uncertainty about their ability to hedge themselves goes up, and they're going to charge me a higher price for the option that I want to reflect that higher uncertainty on their part.
So you may have answered your professor with that definition of liquidity, right?
I didn't answer it that way all that time
that's
ago.
That's very clever, If you did it in college, that would be very impressive. But another definition that's thrown around is sort of the central banks and printing of money, right? How have central banks impact the volatility, or have they? Are they explicitly targeting it, implicitly targeting it? How should people think about that?
So the answer to that is they definitely are targeting it. right? They are not actively involved in suppressing it in an absolute sense. So they're not going out and offering S&P call options or put options into the market. But what they are doing is, I think there's two components associated with it. The first is that the primary response function of the Federal Reserve is to lower interest rates in the face of significant economic uncertainty. The way they think that works is through what's referred to as the Euler coefficient, which is the relationship between consumption and interest rates. Theoretically, a higher interest rate dissuades me from consuming something today, right? Says I get a higher reward for choosing to not buy the steak sandwich today and waiting for an extended period of time because I'm earning interest in the bank. So I should try to hold on to my money and keep it. That's how they presume the cut in interest rates work.
Yeah.
I think it works in a very different fashion, which is by cutting interest rates, they're causing the value of a type of collateral, a treasury bond, to rise. And if the value of a portion of my portfolio goes up, I have increased purchasing power in the marketplace. By augmenting my purchasing power in the financial assets, they're actually suppressing volatility. They're increasing the proportion of people who are capable of making purchases. There's a good paper that was put out by Jonathan Parker of MIT at the tail end of 2019 that highlighted the dynamic of systematic rebalancing of target date funds as a meaningful influence on the suppression of volatility. And that's a great illustration there, because if you think about a target date fund, which automatically holds an exposure to bonds and equities, if I cut interest rates and the bond portion rises, well, then I have to rebalance by selling some bonds, which the Fed then comes in and addresses through quantitative easing as the second stage in the process. So the bonds are very liquid and have risen in value. And now I have to go turn around and buy equities because they've become inappropriately low as a proportion of my portfolio. Right? That pattern is actually a significant vol suppressant. It's not working the way I think the Fed thinks it is. It's not affecting the real world in the same way, but that's a lament that we're all very familiar with at this stage in markets, right? That the markets feel disassociated from the fundamental experience we have.
It seems to me when you look out and, again, loosely call volatility, and cover anything option related, it feels like the demand and the use of options is going up, both at the institutional level, but certainly at the retail level. How do you think about that? How do we think about that in sort of an opportunity set for sort of investors such as ourselves or our ETFs? What is sort of the opportunity there?
Well, it's interesting. So the godfather of many derivatives, Emmanuel Derman, has a great expression, which is what we're ultimately going to find is the vanilla is the hardest to price, right? And what he means by that is that the underlying instrument, an equity, for example, Microsoft, I don't know what the right price for Microsoft is. I don't have a tremendous forecast for what Microsoft's cash flows are going to be next year or anything else. But given knowledge of where Microsoft is priced, a derivative like a call option or a put option actually becomes relatively easy to price. The source of increase in demand, I think, has been a function of two things. One is, on the retail side, the availability of commission-free option trades through platforms like Robinhood, et cetera, and the gamification of that has dramatically increased the small lot participation. When I say small lot, I mean trading in irregular sizes. The usual size for an option is for a 100 share contract. You can now get those smaller, right? The second component that is occurring is that there's been a tremendous amount of growth in demand for out-of-the-money call options. And this kind of falls into the category of, is it cheap or is it low price? I can buy an out-of-the-money call option for very little money that has very low prospects of ever actually going in the money and giving me the opportunity to purchase that. Those are the areas where we've seen a lot of growth on the retail side. And it's, in a lot of ways, it's unfortunate because you've seen a tremendous amount of money burned in that.
It's almost an inadvertent result of, again, the chase for yield, chase for returns, as well as the liquidity provided by banks. It's forcing some investors to, again, seek out higher upside potential because sort of the traditional sources of yield and returns have been squeezed out.
Well, I would argue that you see an element of frustration and desperation, particularly amongst younger people in this environment. So one of the inadvertent outputs from the Fed stepping in and engaging in the manner I was describing before to suppress volatility is that we've seen a tremendous increase in valuations and prices. Another way to think about that is that those who are working and trying to buy into the system are able to buy less. What you're really doing when you buy those deep out of the money call options is that you're buying a lottery ticket. It is a small expenditure that can radically change your life. We see this explicitly with GameStop, for example, right? An individual spent relatively small sums of money and became a near centimillionaire on the basis of a move in markets that almost nobody could have foreseen. That tends to be the province of a little bit of desperation, right? We see this in the older generations, retired people playing casino games. It's a controllable expense. I'm not going to spend that much. I'm going to put $1 in or a quarter in every time I play the slots, right? So I can control the pace of my burn. It's the same as buying low-price call options. That's the most I can lose, right? I can lose 25 cents. The second feature of it, though, is that it is a small enough expenditure that has the capacity to meaningfully change the trajectory. If you have that home run, then it can alter the outcome. And I think that's a pattern of behavior that we're seeing, to me, that speaks generally to a form of desperation. This goes back, actually, unfortunately, to the SVOL characteristics, which is if you're not desperate, if you actually have the capability to say, you know what, I want to earn a reasonable rate of return, you can flip to the other side of that. And that's part of the opportunity set that exists right now. It's just to kind of pull back a little bit and say, hey, how do I take advantage of the opportunity set as it exists today to generate an attractive but not life-changing return?
In the current environment, trading volatility on both the short and long side is one of the most attractive opportunities in the market. But it requires expertise. New regulatory changes have opened the door to that expertise to a whole new class of investors. Simplify is at the forefront of offering new and exciting products like SVOL, which give investors exposure to these opportunities without having to manage complex option strategies.